Hello. As we enter 2018, there's a feeling of optimism about the world economy. The traditional seesaw scenario of one set of markets accelerating whilst the other experiences a slowdown in growth appears to have been broken, with emerging markets as a whole looking set to accelerate, whilst developed markets provide stable growth. This year, we've identified 5 key reasons for emerging markets to be optimistic. These are the benefits of structural reforms, such as in Mexico and India, the recovery of commodity prices to a new normal, a growing and stable demand from developed markets, especially in Europe and Japan, Chinese fiscal stimulus, and China's Belt and Road Initiative. To balance this, we believe that there are 5 corresponding things emerging markets ought to be wary of. Interest rate hikes in developed markets, led by the US, inflationary pressures in emerging economies, protectionism and trade tensions, particularly between the US and China, geopolitical tensions, as with North Korea, Qatar and Iran, and emerging market elections. On the balance of these 10 points, the collective emerging markets GDP looks poised to rise modestly by 4.9%, thereby stimulating investor interest. However, productivity is still a key concern. As we look around the world, Argentina appears well set to lead Latin American growth, following President Mauricio Macri's success in the congressional elections in October 2017. His tax reforms aim to lower the cost of doing business, and together with the relaxation of certain regulations, this will attract investment to a broad range of sectors. Having experienced a torrid few years, 2018 looks more positive for Brazil, with economic growth returning on the back of rebounding private consumption and strengthening exports, supported by business-friendly policies, including energy, mining, and telecom reforms. Nevertheless, uncertainty still remains, due to the fact that an anti-reformist stance may return following the October presidential elections. Mexico is already seeing the benefits of its oil reforms, with an increase in oil and gas production and global rising prices. However, despite having a strong domestic consumer market, there are concerns over NAFTA renegotiations and the risks to reforms following the 2018 general elections. Moving across to Central and Eastern Europe, growth here will be led by Poland, the Czech Republic, and Hungary, benefiting from the outsourcing trend of Western European companies and also increasing exports of cars and electronics. However, labour shortages will leave growth more dependent on productivity gains, which are harder to come by. In Turkey, the economy looks set for a slowdown, with inflation hitting a 13-year high at the end of 2017. This is compounded by rising short-term external debt and a widening current account deficit due to a reduction in inbound capital, exacerbated by Turkey's geopolitical stance against the West. In Russia, recovering commodity prices will help, but only result in a slow level of growth, with real GDP growth set to remain well below historical highs. The March presidential elections look certain to maintain the status quo, and therefore concerns remain with regards to the government's influence on key sectors, its reliance on energy exports, and the need to upskill the labour force. On the African continent, Nigeria is experiencing a gradual recovery in the oil sector, which led the economy out of recession in 2017, and will drive economic growth in 2018, supported by power reforms which will unlock opportunities across sectors. Further south, uncertainty clouds South Africa, following President Zuma's cabinet reshuffle and previous policy inconsistency. This is fueled by distrust from the business community, and all this will likely undermine the impact of reforms across the labour, power and state-owned enterprises. In the Middle East, the rapid consolidation of power by Crown Prince Mohammed bin Salman in Saudi Arabia has shifted the country's consultative policy-making model towards a more directive approach. This will likely propel his ambitious economic reforms and diversification program to reduce the kingdom's reliance on oil, signalling opportunities for companies as government services such as airports and utilities get privatised. India's growth looks set to accelerate. as the negative impacts from demonetization and the implementation of the goods and services tax begin to dissipate. Next on the Modi agenda will be the gain a majority in the Rajya Sabha, or the upper house, following the April elections, which will facilitate his pursuit of more controversial but much needed reforms such as land acquisition. Following President Xi Jinping's consolidation of power at last year's 19th Party Congress, China will continue its globalization agenda, notably through the Belt and Road Initiative. However, this will be balanced against domestic needs, specifically managing provincial debt and containing inflation. It will no doubt pursue these priorities with one eye on any US policies aimed at reducing its trade deficit with China. In Southeast Asia, Cambodia, Laos, Myanmar and Vietnam will continue to represent the fastest growing economies, registering a strong 6 to 8% GDP growth thanks mainly to growing consumer demand and increasing FDI, whilst policy reforms and rising government infrastructure spending will drive growth in the larger economies of Indonesia, Malaysia and the Philippines. Many of these markets have strengthened their position by building foreign exchange reserves to protect themselves against capital flow volatility. Emerging markets' fortunes will never be completely decoupled from events in the developed markets. However, 2018 does appear to be a year in which growth in emerging economies lies more within their control than ever before. Thank you very much.